everyone. I'm Josh Scott, Director of Conference Programming at Pensions and Investments, and I am excited to be joined today by Ryan Dunfield, Managing Principal and CEO at SAF Group, which partners with AGF Investments on a number of projects. Hi, Ryan.
Good morning.
Let's go ahead and jump right in and take a look back to kick things off. And what trends have you seen within the private markets space over the past 5 years, and do you expect them to change moving forward?
Sure. One trend we've seen on the capital side has been this democratization of private credit and private markets for retail and high net worth investors. Historically, there had been a few public general partners, such as Apollo or Blackstone, that were options for retail investors to invest through those public listings. But there's been an evolution of regulatory changes that have allowed the retail and high net worth investor to get access through different feeder products to private market funds. And in fact, we've seen, over the past 5 years, about a 15% annual compound rate increase, of which, retail and high net worth investors have been participating in the private markets. I think it's something we're going to continue to see this trend as a real capital source for private market funds, and offer these lower volatility strategies to not only large institutions and pensions, but also make available for the retail and high net worth investor.
Yeah, that's a great trend to recognize, opening up the space more and more money will be coming in. But within private credit specifically, where are you seeing opportunities right now?
Sure. So on the theme of regulatory changes, post the global financial crisis in 2008, 2009, there was a significant amount of change afoot in the bank regulatory market, which really started to sort of blossom the private credit role in the corporate and commercial loan market. And we've seen that supply disruption associated with those regulatory changes result in non-bank lenders making up a significant portion of market share in that corporate credit and commercial loan market. For example, in the US today, approximately 25 to 30% of all new issuances in the corporate credit and commercial loan markets are funded by banks, where the vast majority today are non-bank lenders. These regulatory changes, however, haven't necessarily affected all jurisdictions at the same cadence. Jurisdictions such as Canada, we're really in the first inning here on some of these regulatory changes affecting the market share landscape of the corporate credit and commercial loan market. If we run with that same stat of market share, in Canada, the banks still today make up 85% of the commercial loan and corporate credit market, compared to the US at, again, 25 to 30%. So we see this as, early days for new substitutes to become available for commercial and corporate borrowers. And, this trend should set up quite nicely here over the next 5 years, somewhat mimicking jurisdictions such as Europe and the US.
So you spoke a little bit about things coming out of the global financial crisis. Taking a look back on the past year, another sort of disruptor in this, investment market was COVID-19. How has COVID-19 impacted the private credit market specifically?
Sure. So we see sort of two opportunities taking shape for private credit as we come out of this COVID environment. Number one, there's certainly great businesses that had to pivot their business model to accommodate the effects of COVID. An easy example of this would be, say, larger retailers, where their business model certainly had to get online, if it wasn't already, very quickly, which would have changed some of their inventory management processes. As brick and mortar stores can open up again, there is going to be a more working capital intensive model for these businesses, or in short, they're going to have to put more capital towards their working capital. And often we find that banks, especially here in Canada, we find they're often, backwards looking with respect to how they calculate capital available for their borrowers. So these businesses are going to need to find alternative credit providers that can feel comfortable with the ramp up of their business as customers start flooding back into their stores again. Secondly, the past 12 months have certainly been very unique in the capital markets, and I think that is has somewhat paused some of the dry powder inside of traditional buyout private equity. A lot of these private equity firms over the past 12 months have been, very focused on the portfolio, whether that's ensuring COVID exposed businesses are on sound footing, or, quite frankly, taking advantage of an extremely white hot equity market for exits. And we have seen a substantial amount of exits and refinancings. We see these private equity folks starting to focus back on their dry powder, putting capital to work, and that's going to create a pretty material influx of capital requirements to support these buyouts and an uptick in the sponsored loan market.
Thanks, Ryan. Two big things for the viewers to take note of. This has been fantastic. I want to thank you again for joining me today and joining us. I hope that you all as viewers have enjoyed as well, and we'll look forward to seeing you again soon. Thanks.
Thank you.